Hello, successful people. Welcome back to the Iron Fry Success Channel. I'm TK.
And I'm Mo.
Thank you to our subscribers.
And if you're new to our channel, welcome.
In today's video, we're going to answer a question posed by subscriber OKC, who asked, have you ever done a video explaining how construction loan payments work? So today, this is that video. So first, let's talk about what is a construction loan. A construction loan is a short-term loan, usually for about 12 months, that is meant to cover the costs associated with building your new home or new structure.
So what does that include? Well, a construction loan could include the cost to clear your land, lumber, and the cost to construct your home, and could include the cost of your land as well.
Yes. Okay, so let's talk about when you go to a lender and you ask to take out a construction loan, how does the builder get paid? So the first thing that happens is the builder will give you and your lender a draw schedule. Mo, can you talk about what a draw schedule is?
So a draw schedule is a schedule that the builder gives you that lays out what they should be following to construct your home. So they may need an initial payment to, say, buy the concrete to lay your foundation. And what happens is they periodically make draws on your loan. So that's what your schedule is. That's what your loan schedule is, your draw schedule is, rather.
So the draw schedule is the builder is saying, you know, I'm going to draw 1 is this much money, or draw 2 is this much money. So they lay out when and how much.
Yeah, and they do it in intervals as they're doing the work. And what happens is, as they're doing the work, they're in communication with you and with your lender, and your lender is sending out someone to do an inspection to make sure that they're doing the work. And at least in our case, as they were making those draws, we as the homeowners and the people, well, the folks who drew the loan would need to approve those draws. So it's very important that you have someone either on site, even though your financial institution is going to have someone to inspect, but you want to make sure that those things are being completed as the builder is making draws, because you don't want to approve something where the work hasn't been done.
That's right. And one thing to add to that, when the lender sends out an inspector, they're not inspecting the caliber of the work. They're not inspecting the quality. They're really just looking to see, did the builder do this thing? Because really, besides those initial startup costs, every time the builder makes a draw, it should be for something that they already paid for. The lender isn't going to pay the builder up front and then they do the work. At least with our lender, that wasn't going to happen. So now that the builder has asked for a draw of money for something that they've done, we approved it, the lender sent the inspector, they approved it, what's the next thing that happens?
Seeing how you're going to actually make the payments on your construction loan. So next we're just going to talk about how those payments are determined.
Yes. So I went back and looked at our loan documents so that we could talk about this, because when you look it up and research it online, it says that you have an interest rate that's an annual interest rate. And that annual interest rate is divided by 12 because your construction loan is usually a 12-month loan. And then that percentage is applied to the money that the builder has received out of your loan. So we're going to give you an example of what that looks like.
And on the construction loan, you're only making payments on the interest.
Yes.
So you're making interest payments on the amount that's drawn. And it increases incrementally as more draws are made. But we'll explain it.
We'll show you an example. So let's say that you are taking out a construction loan for $700,000. and you have not yet paid off your land like we did not yet. And so out of that $700,000, $50,000 is going to be used to pay off your land. Not every construction loan lender will allow that, but ours did. So now you've used $50,000 before you've even done anything. Next, your builder needs startup cost money. That's the soft costs. That's they need to finish site clearing and get the foundation ready. So now that's another $50,000. So now out of your $700,000 construction loan, there's $100,000 used before any actual building has occurred.
Yeah, and you'll be paying interest on that once that construction loan has been, settled with your lending agency. So you have $100,000 that you're going to be paying interest on right off the bat.
Exactly. So in our fake example that I saw online, if you have a 6% interest rate, which is usually an annual interest rate, and to find your monthly interest rate, you divide that by 12. So what we have here is 6% divided by 12 is 0.005. That is the monthly interest rate. So if you were to multiply 0.005 by that $100,000, that would be the amount of your first monthly payment. That's right after you've taken out the construction loan. But what happens, Mo, if the builder, let's say in 2 months, they've done some work, like maybe they've done the foundation and they've started framing your house, so they had to pay for the lumber and the labor costs, they're going to make another draw, right?
Yes. So as the builder is making draws, that money stacks, and you're going to be making interest payments on the total amount drawn, not just that increment that was just drawn out, but on the total amount that's drawn. So now, after foundation, after framing, and any other work that they may have done, surveying and such, you may now be up to $200,000 that you're paying interest on at this point.
Right. So if you take the interest rate of 0.005 and you multiply it by 100,000, check my math, people, because it should be $500. And that means in month 1, you pay $500. Let's say in month 2, there's no other draw. Still, all you've used is $100,000. So your payment in month 2, $500. Month 3, the builder asked for that other $100,000. Now that's $200,000 that's been used. That $500 now goes up to $1,000. So when you're saying it's cumulative, once they use $300,000, that's another $500, $400,000, another, and it just keeps going like that until you reach the end of the loan.
Now, of course, in our case, the draw schedule was much more aggressive, even though they gave us a layout, a printout of when they were going to be making draws and the amounts. The draw schedule deviated from what they actually gave us, and it was much more aggressive. So, say in the first month, we paid about $900, but the second payment jumped up to about $1,300 to $1,800. So you just have to be on top of your draw schedule, and you can kind of follow it once you approve the draws. They give you an idea of what your next payment might be, as long as you know your interest rate and you can do the math.
That's right. And one of the things I noticed, Mo, is when I was preparing for this and wanted to see if that, annual interest rate divided by 12 was actually what happened to us. And what I saw was our annual interest rate was divided by 11, not 12. Because in month 12, it was assumed that our house would be done and we'd be refinancing that into the permanent mortgage. So I think that also contributed to our payments being higher than this divided by 12. But the good news is that if before you actually go through with your loan, and I think that's the recommendation you were making, ask your lender to do a projection of what it would look like, assuming the builder, had a fictitious draw schedule. You can kind of see how much money you'd be paying a month. Mo, can we talk about what happens when you get to the end and 12 months goes by and you don't refinance into a permanent loan because your house is not ready, like ours was not.
Yeah, so at this point, now you have to talk with your lender. As you're getting close, I would recommend about 60 days before the builder is saying your house is supposed to be done. Check with your lender, especially if you are doing, well, if you're doing full custom where you have a construction loan. You want to check with your lender because you run the risk now of getting penalized by your lender, and that could be a hike in the interest rate or other.
May I say, sorry to interrupt, that's exactly what happened to us actually. Well, I just read those documents. Our interest rate was 5.5%. It went to 8.5. Once this house was not ready in 12 months, that's what happened, 8.5%.
Yes, and we won't even get into some of the other things that we had to do, but thank God that we were able to end our financial situation with the builder, and the house was completed. We went, 2 months over?
Yes.
And we were able, through communication with our lender, be able to work through avoiding some of those penalties, but because those interest rate payments were stacking by the time, the ideal situation is by the time your home is completed and the builder has completed all of their draws, your payments on your house the interest payments will be somewhere in the ballpark of where your payment on your house would be.
The actual mortgage payment.
The actual mortgage payment. Right. And you can imagine how that can be that can become a little disturbing when, say, you're living in a rental. So now you're paying a rental and your mortgage, but your house is not yet ready. So that's just something to think about as you're making those interest payments and the builder is making those draws, if you're renting or paying some other mortgage.
Yes. So to recap, construction loan, short term, usually 12 months. The interest rate on your construction loan is typically in an annual rate. Divide that by 12 or by 11, and you can find out what the monthly interest charge is going to be. Look for a draw schedule that says how much money the builder is going to draw out. Know that that money is going to stack as your house is being completed. And I think you also touched upon, the fact that there is a draw schedule does not mean that your builder is going to stick to that in the order of what is done on your home.
That is correct. And just any questions that you may have about payments and how your construction loan is going to work, make sure you communicate all of your concerns to your lender. You can do it up front. Ask them. We asked several questions before we decided to go with our lender, and then even after that, we continue to ask questions as to how it works.
Yes, and just to add one more thing, our lender did do some, sample of what it would look like and how much our payments would be and projections before we actually signed on the loan. So we hope that you got some good information on how construction loan payments work from this video. Please subscribe for more information about new home construction and model home tours in and around the San Antonio area.
And continue to follow us as we continue to turn our house into a home. And as always, until next time, be peaceful, stay prayerful, and count your blessings.